Gold and silver markets are experiencing breakthrough movements that signal fundamental shifts in the global monetary system rather than temporary price fluctuations driven by news cycles or speculative enthusiasm. The approach of gold toward $5,000 per ounce and silver toward $100 represents mathematical inevitability resulting from structural problems that have accumulated over decades of fiscal irresponsibility and monetary manipulation. These price movements reflect the beginning stages of what monetary historians recognize as system reset periods, where existing arrangements prove unsustainable and markets seek new equilibrium points. Understanding this breakthrough requires examining the structural foundation problems that have developed within the global financial system over recent decades. Government debt levels throughout developed nations have reached ratios relative to economic output that historically coincide with currency crises and monetary system changes. The United States federal debt exceeds $33 trillion while continuing to grow faster than economic output can sustain. European Union member nations collectively carry debt burdens that require constant refinancing at increasingly expensive interest rates. These debt levels create mathematical constraints where governments cannot service obligations without continued monetary accommodation that undermines currency purchasing power. Central banks face impossible choices between allowing government defaults that would collapse financial systems or continuing money printing that destroys currency credibility. The mathematical inevitability of this dilemma drives systematic movement toward alternative monetary assets, including precious metals that maintain value independently from government fiscal policies. The global debt burden extends beyond government obligations to encompass corporate debt, household debt, and unfunded liabilities, including pension systems and social insurance programs. Total debt across all sectors in developed economies approaches 400% of gross domestic product in many cases. These aggregate debt levels exceed what economic growth can service without continued monetary expansion that dilutes currency purchasing power while transferring wealth from savers to borrowers and asset holders. Central bank policies worldwide have evolved beyond traditional monetary policy toward direct market intervention and asset price manipulation that distorts normal price discovery mechanisms. The Federal Reserve's balance sheet has expanded from under $1 trillion in 2008 to over $8 trillion, currently through quantitative easing programs that purchase government bonds and mortgage securities. European central bank balance sheet expansion follows similar patterns, while Bank of Japan has purchased Japanese government bonds equivalent to the entire Japanese economy. These central bank interventions create artificial demand for government debt that enables continued deficit spending while suppressing interest rates below levels that would reflect actual credit risks. The artificial suppression of borrowing costs encourages additional debt accumulation while punishing savers and fixed-income investors who receive returns below inflation rates. This systematic wealth transfer from productive savers toward leveraged borrowers creates social tensions while encouraging speculative investment behavior. The erosion of confidence in paper assets becomes apparent through multiple indicators, including currency debasement, negative real interest rates, and systematic underperformance of traditional safe haven investments. Government bonds that historically provided portfolio insurance during economic uncertainty now carry negative yields in many developed economies. Bank deposits earn interest rates below inflation levels, while facing potential confiscation through bail-in policies during banking crises. Investment-grade corporate bonds carry yields that fail to compensate for default risks when economic cycles turn negative. Real estate investments face affordability crises that prevent normal demand while regulatory restrictions limit supply responses. Stock markets trade at valuation multiples that historically precede major corrections while depending on continued monetary accommodation for support. These conditions encourage systematic movement toward alternative assets that provide genuine value storage and inflation protection. Gold's approach toward $5,000 per ounce reflects institutional recognition that traditional monetary assets cannot provide purchasing power protection during currency debasement periods. Central bank gold purchases have reached record levels as monetary authorities diversify reserves away from currency-denominated assets toward neutral monetary metals. Countries including China, Russia, India, and Turkey have dramatically increased gold reserves while reducing dollar-denominated holdings that face confiscation risks during geopolitical tensions. The mathematical projection toward $5,000 gold assumes continued monetary accommodation at current rates, combined with normal historical relationships between money supply growth and gold prices. If central banks continue expanding money supplies at recent rates to service government debt obligations, gold prices must adjust upward to reflect currency debasement. Historical analysis suggests gold prices lag monetary expansion by 12 to 18 months before adjusting to reflect actual purchasing power changes. However, gold price projections may prove conservative if currency crises accelerate or international monetary system changes reduce dollar demand as reserve currency. Multiple countries are developing bilateral trade arrangements that bypass dollar settlement systems, while central bank digital currencies could replace traditional reserve currency functions. These structural changes could accelerate gold demand while reducing automatic dollar support that has enabled continued monetary expansion without immediate currency consequences. Silver presents even more compelling breakthrough potential because it combines monetary properties with essential industrial applications that create multiple demand sources operating independently. Unlike gold, which serves primarily monetary and jewelry functions, silver faces growing industrial demand from renewable energy systems, electronics manufacturing, medical applications, and defense technology that cannot substitute alternative materials without performance compromises. The dual demand profile creates unique market dynamics, where monetary demand increases during currency uncertainty periods, while industrial demand continues regardless of economic conditions. Electronics manufacturing requires silver for conductivity applications, where alternative materials reduce efficiency and reliability. Solar panel production consumes substantial silver quantities for photovoltaic cells, where substitution compromises energy conversion efficiency. Medical device manufacturing utilizes silver's antimicrobial properties for surgical instruments and implants, where alternatives risk patient safety. Industrial silver demand shows inelastic characteristics because manufacturing processes require specific material properties that silver provides without acceptable alternatives. Even dramatic price increases cannot eliminate industrial demand when production schedules and product specifications depend on silver's unique characteristics. This inelastic demand provides price floor support during economic downturns while adding acceleration during supply shortage periods. The supply-side dynamics for silver create additional breakthrough potential because mining production faces constraints that prevent rapid response to higher prices. Silver mining occurs primarily as byproduct of copper, zinc, lead, and gold mining operations, where silver represents secondary output rather than primary production target. This means higher silver prices don't automatically increase silver supply because miners focus on primary metals rather than secondary silver recovery. Dedicated silver mining operations face permitting delays, environmental restrictions, and capital investment requirements that prevent immediate production increases when prices rise. New silver mines require years of development and hundreds of millions in investment before generating meaningful production. Even existing operations face or grade declines that reduce silver output per ton of material processed. These supply constraints support sustained price advances once demand exceeds available supply. The energy transition toward renewable power systems creates structural silver demand increases that operate independently from monetary considerations. Wind turbine installations require silver for electrical components and power transmission systems. Solar panel deployment consumes increasing silver quantities as renewable energy adoption accelerates globally. Electric vehicle production uses substantially more silver than traditional vehicles for battery systems and electronic components. Energy storage systems, including grid-scale batteries, require silver for power management and electrical connectivity applications. Smart grid infrastructure utilizes silver for communication systems and automated control networks. These energy transition applications represent permanent demand increases rather than cyclical consumption patterns that can decline during economic slowdowns. The infrastructure investment requirements for modernizing electrical grids, transportation systems, and communication networks create additional commodity demand pressure that extends beyond silver to include copper, lithium, rare earth elements, and other critical materials. These infrastructure programs require massive material inputs over extended timeframes while competing with existing industrial demand for limited supply resources. Copper demand faces particular pressure from electrical infrastructure expansion because copper provides essential conductivity properties for power transmission and electrical system applications. Electric vehicle charging networks require substantial copper installation, while renewable energy systems use copper for power transmission from generation sites to consumption centers. These applications compete with traditional construction and manufacturing demand for limited copper supply. The combination of monetary silver demand with industrial consumption creates potential for much sharper price movements than gold experiences during supply shortage periods. While gold primarily faces investment demand that can fluctuate with market sentiment, silver faces industrial demand that must continue regardless of price levels. This creates asymmetric demand patterns, where silver shortages generate more extreme price responses than gold shortages. Historical precedent demonstrates silver's volatility potential during supply-demand imbalance periods. The 1979-1980 silver surge saw prices advance from $6 to $50 within 18 months as monetary uncertainty combined with supply constraints. The industrial applications that exist today were minimal during the 1970s, suggesting even greater volatility potential under current conditions, with extensive industrial demand competing with monetary investment flows. The quiet reset process occurring within global monetary systems operates through gradual changes that accumulate towards system transformation rather than dramatic overnight changes that attract media attention and political intervention. Central bank policies continue accommodating fiscal needs while gradually reducing currency purchasing power. International trade arrangements slowly bypass traditional reserve currencies while developing alternative settlement mechanisms. This gradual transformation reduces political resistance while building infrastructure necessary for more substantial system changes when current arrangements become unsustainable. Countries develop bilateral currency arrangements and precious metals reserves while maintaining normal diplomatic relationships. Financial institutions prepare alternative payment systems and precious metals capabilities while continuing traditional operations. The reset process reflects recognition among monetary authorities that current debt levels cannot be serviced through normal economic growth and require either default scenarios that destroy financial systems or currency debasement that transfers costs to savers and fixed income populations. Currency debasement provides politically acceptable resolution because its effects develop gradually, while alternative scenarios would create immediate crisis conditions requiring emergency measures. However, currency debasement eventually reaches limits where public recognition destroys currency confidence and forces more dramatic system changes. The timing of these recognition points remains unpredictable, but historical patterns suggest they often coincide with external shocks, including geopolitical events, natural disasters, or financial market disruptions that focus public attention on underlying system weaknesses. The commodity shock potential from energy transition and infrastructure requirements extends beyond individual material shortages to encompass broader inflationary pressures that affect entire economic systems. When multiple critical materials experience supply constraints simultaneously, it creates generalized price inflation that affects all sectors dependent on material inputs for production processes. These commodity-driven inflation episodes differ from monetary inflation because they reflect genuine supply limitations rather than currency debasement effects. Central bank policies designed to address monetary inflation through interest rate increases cannot resolve supply shortage inflation and may worsen conditions by restricting investment in supply expansion projects. This creates stagflation conditions where economic growth slows while inflation accelerates. The global financial system reset process involves multiple simultaneous transformations, including currency relationships, trade settlement mechanisms, central bank policies, and international monetary arrangements. Each component interacts with others in complex ways that create unpredictable timing and magnitude for overall system changes. Understanding individual components provides insight into transformation direction while recognizing that system complexity prevents precise prediction of transition timing or specific outcomes. Investment implications of system reset processes favor real assets over financial assets because real assets maintain value independently from currency changes, while financial assets depend on currency stability and counterparty reliability. Precious metals provide the most liquid and portable real assets, while commodities, real estate, and productive assets offer alternatives with different risk and return characteristics. However, investment allocation during system transitions requires understanding that traditional portfolio theory assumptions may not apply when monetary systems undergo fundamental changes. Correlation relationships between different asset classes can shift dramatically during crisis periods, while liquidity characteristics change when financial markets experience stress. Conservative positioning with substantial precious metals allocation provides insurance against system changes while maintaining flexibility for opportunity recognition. The breakthrough movements in gold and silver prices represent early indicators of broader monetary system transformation rather than isolated commodity market developments. Understanding these movements as part of systematic change process provides context for recognizing additional transformation signs, while preparing for conditions that may differ substantially from recent historical experience. The mathematical inevitability underlying precious metals price advances reflects structural imbalances that require resolution through either system collapse scenarios or managed transition toward more sustainable monetary arrangements. Precious metals serve as neutral assets that maintain value across different monetary systems while providing option value during transformation periods when traditional financial assets face uncertainty. This analysis examines observable trends and historical patterns rather than providing investment advice or predicting specific outcomes. System transformation processes involve complex interactions that can evolve unpredictably while creating both opportunities and risks that require careful evaluation. Understanding transformation dynamics provides framework for assessing current conditions while maintaining perspective about uncertainty inherent in major system changes. The quiet nature of current reset processes may accelerate toward more obvious changes when mathematical constraints force recognition of system unsustainability, or when external events focus attention on underlying structural problems. Preparation for various scenarios requires understanding both gradual transformation possibilities and more dramatic change potential, while maintaining flexible approaches that adapt to evolving conditions.